There we go. Okay. Hopefully you should be hearing now. I apologize. Let me know if you can hear me now. I think we should have everything up and running. I'm sorry for the technical difficulties this morning, everyone. Let me know if you can hear me fair in the chat. I believe it should hopefully be working now, and we can actually jump into the webinar proper here. I will, there we go. Okay, cool, awesome. All right, we got it all running, got it all working. Sorry for the delays and the technical difficulties, but now we should be able to jump into this. We do have the disclaimer on screen here. I think everyone has been looking at this for quite a while now. I'll run through it very quickly. Very basically, trading, it involves risk. Trading anywhere involves risk. So basically, you just want to trade with money that you can afford to lose. That's true on Nadex. It's true trading anywhere. Also, I'm going to be placing trades. Going over binary options today. None of the trades I'm going to be placing are going to be any kind of recommendations for what you should trade. They're just going to be to functionally show how binary options work. I'm going to jump over to the next slide because we spent a lot of time looking at this disclaimer screen here. Let's jump on into the fun part of the webinar. Real quick about me, I've been working at Nadex since 2017, and the last 4 years or so have been focused on our products on our platform. So I like to do these webinars, give an overview of our products, and just go run through all the basics of how they work. I generally trade equity and equity options. In my own time, I've been trading about 12, 13 years-ish. So ever since I was old enough to actually legally open an account. Yeah, let's jump into the actual stuff you guys are here for. So just a quick agenda today. We're going to go over what binary options are, how they work, the risk reward proposition of them. I'm going to go over how to enter a position, how to close a position, understanding sort of how they're priced. So the time value of them, the pricing, all the choices you have in products, and then we're going to jump over to the platform and do some practice trades there. So binary options, what are they? Binary options are, and actually before I jump into it, if you do have any questions throughout the webinar, throw them onto the chat. I do have it up on my second screen here so I can see it all coming through, or if we do run into any other technical difficulties, let me know, and hopefully we don't, knock on wood, and I'll try to fix it at that point. So binary options. So binary options are very short term, and they're going to be very defined risk reward contracts, and it's really just based on an event, a statement, prediction. You can really have a binary option on anything. The primary binary options that you're going to see on the Nadex exchange are going to be on your more traditional financial products. So things like euro dollar, things like US 500. You have commodities like oil, gold, right? And really, it's just going to be a question of something like, will euro dollar be above or below a certain line, a certain strike price at a certain time? Binary options, prediction markets, event contracts, there's a lot of different names for these type of contracts, and they really are the same thing. It really just comes down to you have two potential outcomes. One is going to be right, one's going to be wrong, really. It's just a yes or no question. And one of the main things about binary options as well is when you are buying and selling, when you are entering a contract, the potential risk and reward of that contract, of the binary option, is all going to be known up front. So you're always going to know how much you're actually paying to get into a contract up front on Nadex, and you're always going to know what your potential payout is going to be or what your potential profit is going to be as well when you actually enter the contract itself. So when you're looking at the binary options, there's going to be really three components that make up the how the binary options work. There's going to be three sort of parts of three components of the binary option. There's going to be one, the underlying market. So we just talked about the underlying market a little bit. The more traditional ones that we do have on the exchange are going to be things like euro dollar, things like US 500. However, you can have them on many different things. So for example, we have binary options on event contracts. So things like what will CPI be? So we had CPI come out, I believe, a little bit earlier this week. We have fairly high inflation these days. So if you do want to go ahead and trade those event contracts, those do come up, as well as a number of other ones that are basically asking you questions on, for example, what will jobless claims be this week? Will it be over or under a certain number? So that's going to be the underlying market. The condition or the strike price is just going to be that level. So will euro dollar be greater than 1.1000, right? So that's going to be the actual condition. You want it to be above or below that level, and then you have the expiration time. That's just going to be the time at which you need that strike price to be either above or below, right? So something like will euro dollar be greater than 1.10 at 3 p.m. today? And so those are going to be the three different components of the actual contract itself. All of our contracts or all of the binary options are going to trade from a range of 0 to 100, right? So you are, they're all going to exist between that 0 to 100 point, and depending on where the binary option is in relation to the underlying market, that's going to predict how, or that's going to give you where you're actually entering into that contract. So I'm a little bit tongue-tied today. I think I got flustered trying to figure out all the technical difficulties at the start of this webinar. So this is important. What does the price of a binary option actually represent, right? So when you're looking on the platform, and you're going to see there's going to be lots of prices for buying, lots of prices for selling, and every different binary option and with every different strike price is going to have a different price for the buy and the sell side. So basically, as we talked about, binary options is going to be a true or false prediction. If the contract is true, if at the time written in the binary option, it is, if you buy and it's greater than whatever that line, whatever the strike level, the option is going to settle at 100. You're going to get a $100 payout. If it's false, it's going to settle at 0. Because these binary options sit in the 0 to 100 range, you can sort of think of them as existing the 0 to 100%, and therefore the actual pricing of that binary option reflects the probability of that event occurring. And so you can see down here we have an order ticket like you're going to see on the platform itself, and we see if you look and take the midpoint price, so we have 46.25 on the sell side, 49.25 on the buy side. The midpoint of that is going to be 47.75, the right in the middle, and that's actually going to tell you that the market thinks that binary option has a 47% chance of expiring correctly on the buy side, right? So if it's something like, will US 500 be greater than 4,000, and that's pricing like this, the market's generally pricing a 47% chance of that actually occurring. On the sell side, it's very similar, but it is actually the inverse, right? So on the buy side, it's always going to be that midpoint. On the sell side, it's going to be 100 minus that midpoint. And so you can see here, both of these options on the left and on the right are pricing sort of the same probability of this event happening. On the buy side, this is a 47.75% probability of this happening. And on the sell side, with this pricing here, you also have a 47.75% chance because it's 100 minus that midpoint of 52.25. This is a point I think not a lot of people really understand about these binary options. So it is important to, when you're trading these, keep in mind that the midpoint is going to be the probability of this event occurring, or at least it's what the market is pricing as a probability of this event occurring at that specific given time. So we talked a little bit about the strike level. So we have also the risk and the reward kind of nature of these binary options. These do exist in that 0 to 100. So we talked about the probability being whatever that midpoint pricing is of those binaries. The binary options, at least on Nadex, and actually all Nadex products, are what we call fully collateralized. So what you put up when you actually first enter that trade, that's going to be the maximum you can lose on that trade. And so that's going to be the maximum risk that you can actually take on. So if I were to get in a previous example, if I were to put in, I think it was about $47 to get on the buy side of that contract, 47 is going to be the absolute maximum I can risk. The absolute maximum I can lose. That's going to be my maximum risk, right? You can never. There's no margin calls. There's no extra leverage on Nadex. So like if you're trading, with the brokerage, you're trading with a little extra leverage. You can run into examples in other places where you can actually end up risking more than what you put up. And Nadex is just going to be that fully collateralized. You can only actually lose what you pay to get into the contract initially. So the other thing about these fully collateralized contracts is that both the buyer and the seller are going to put up the full $100 price when they get it. So if we have an option that's pricing at, let's say, $40 on the buy side, when you enter that contract, you're putting up $40. That's going to be your total risk. There's someone else on the exchange that you're trading against that's actually putting up this $60 on the other side to make up that entire $100 kind of total pool. And then at the end of the contract, either the buyer or the seller is correct. The buyer will get $100 if they are correct. The seller will get 0, or if the seller is correct, it's the inverse. The seller will get 100. The buyer will get 0. Right. So the buyer's collateral is always going to be the buy price. The seller's collateral is going to be the difference between the 100 and that sell price, and that is pretty important. So if you're ever looking at the exchange and you see a sell side contract pricing at, say, $70, it's important to remember you're not actually paying as a seller $70 to get into that contract. You're paying 100 minus 70. So you're paying $30 to get into that contract. So that is always important to remember. On the sell side, it is always the inverse of 100 or 100 minus whatever you're seeing to actually get into that contract. And then your maximum reward for all of these contracts are just going to be the kind of rest of that $100 that everyone put in, right? So if you're a buyer, you put in $40, your maximum reward on that, your maximum profit on that is going to be 100 minus the 40 you put in for a $60 potential maximum profit. Same thing with the seller. If you put in, if it's pricing at 70, you put up $30, right? Your maximum potential reward is going to be that $70, that rest of that $100 pool. All of that the other side is putting up for this trade. So we can see a little bit of what we've been talking about here, and we will look into these order tickets quite a bit more when we actually jump into the platform and go through a couple of the examples. But we see here, so will the US 500 finish higher than 46596? So we have, first of all, our underlying market, US 500, 4659.6, that's going to be the strike level we talked about, and then 4:15 p.m. That's going to be that expiration time, right? So that's the three things. You have your underlying market, you have sort of the line in the sand that you need to be above or below, and depending on if you're buying or selling, and then you have the actual expiration time at which you need the underlying market to be above or below that point. You also do have here, so you can see we have a price here of $52.75. You can see when you look down on the order ticket, that is going to be your max loss. So just like what we talked about, when you're putting in, for example, 52.75, that is going to be the maximum you could potentially lose. And then on the buy side as well, the maximum profit is going to be the rest of that $100 pool, right? So if you put in 52.75, let's say it does turn out at 4:15 p.m. to be above this point at 4659.6, you're going to get that $100 payout for that profit of $47.25. And then we see the sell side here too. So you see the price here is 59, but if you go down and actually look at the max loss, you see what your max loss is actually $41. And again, that's because what you are paying to get into a sell side contract is going to be 100 minus the price you actually see here. So 100 minus 59, that's going to be $41. That's going to be the maximum loss of the contract. And then you'll notice the $59 here matches up with the price you're paying to get into the contract. And that's going to be the maximum profit you can actually make on the contract. Will we get this recording, please? Yes. So all of these recordings of all of our webinars, but this one and any past ones I do, are put out on our YouTube channel at the end of the webinar, or a little bit after. It'll probably be a couple hours after. But go over and check out our YouTube channel if you do want to watch this recording if you missed any. So there is this important rule when trading binary options, actually when trading anything on our exchange here. We've been talking for the first part of this webinar on what happens at the expiration of this contract. But just because these contracts do expire, and just because you do get a payout at expiration, does not mean that you need to stay in the contract until expiration. You can actually exit your position early and either lock in any profits you might have made, or actually limit your losses, right? So if you're down a little bit, you can actually get out of the contract early and say, okay, I'll lose a little bit of what I put in, but I won't actually lose that entire amount that I put in. Because at the expiration of the contract, if you do wait until expiration, either you will get the $100 payout, and so you'll get your maximum profit, or you will get a $0 payout and you will lose the entirety of what you paid to get into the option. And we will go over this a little bit further, especially when we jump into the platform. I am going through these slides just a little quickly because I do think it's a little easier to understand all of this when we're actually going through it in the platform together. You can see here though, we do have a deal ticket that allows you to actually close your position early. And I'll show you how to access this when we are in the platform, but very basically on the left side here, we see our set profit target deal ticket. So we basically place a limit order. And if the contract goes up to our point where we want to get out, we can set that profit target, get out and take our little bit of profit, exit it early, lock those profits in, and not risk them for the remainder of the contract. And then we also have our close ticket here. So if you just want to ever exit your contract at the current market price, just get me out right now. Let's lock in these profits, or let's lock in a loss and walk away with a little bit of the funds left to trade another day. You have this ticket on the right here that, again, I will show you how to do when we actually get into the platform itself. But you can see this ticket on the right would be an example of actually exiting the position early at a loss to sort of get your $50 back and not continue to risk your entire $53 you would have paid when you got into the contract. So here we're getting into how these binary options are priced. So we talked a little bit about how the midpoint of the binary option is going to be basically the market pricing the probability of the event occurring. That probability of the event occurring, right? The probability of euro dollar being above a certain line is going to change as the contract moves. It's always going to be changing. As the market rises and falls, right? It's always going to be changing throughout the life of the contract. So the price of that contract is not going to move directly in line with the underlying market. That's because while the price of the underlying market is an important factor in the price of the binary option, it is not the only factor, right? So we have our sort of three major factors that go into pricing binary option. And I will say before we actually get into how these are priced, one important thing to remember is that Nadex itself is just the exchange. We are not actually pricing any of these binary options. When you are trading on Nadex and you are seeing those prices on the exchange, you are seeing either other traders like yourself putting those prices up, or more often than not, you're seeing a market maker that trades on the exchange as well that's putting up those prices and providing the liquidity so that you can get into those positions when you want to get into them. And so that's important to remember that when I'm going over how these are generally priced, it is just a general sort of guide on how they're priced, and Nadex itself is not actually making these prices. So again, the three major factors here, the first one's going to be the position, right? And so the position of the underlying market in relation to where the strike price is going to be a very large factor in how these are priced. And that's sort of, that makes sense, right? It should be fairly heavily priced on how far away the underlying market is from your strike price. If your strike price is up here, the underlying market's way down here, there's not a very high chance that it's going to go all the way up here. So it's going to generally be priced a little bit less on on the buy side. There are a couple other things besides just the general position of the underlying market, though. The next is going to be the time. How much time is left in the expiration of the contract? If we have, the example we were just talking about, where let's say this is euro dollar, making little things with my hands. We have euro dollar trading right here. The strike price is right here. If the binary option ends in 5 minutes, well, we don't have much time to move up, right? So the time is going to factor in there a lot more heavily. But if the binary option doesn't end for another 3 days, well, you have a lot of time for this to kind of move up and be correct. So that time is going to come in, and we're going to look at that a little bit more in the next couple slides. And the third thing is the volatility of the underlying market. Now, this is a little bit harder to quantify and probably a little bit more advanced of these three factors that go into actually how these options are priced. But it is always important to remember, if the underlying market is more volatile, there's more uncertainty around what it might do. And so that is going to affect the pricing that you'll see on the exchange at any time, because the people putting up those prices are, again, a little bit more uncertain if the market is very volatile, going up and down all the time, on where the market will be going next and how much it might move. So if we go through here, we sort of have an example, and I can to illustrate a little bit more about how these pricings work, how the relation of the underlying market to the strike price and the time left sort of factors into the pricing you're going to see. So we have euro dollar here greater than 1.14 at 3 p.m. and this is just sort of a just a general some candlesticks that you might see representing what euro dollar might do. So we have this here. This is our 1.14, right? This is our strike price, 1.14, and this is the hypothetical what euro dollar did. I think this is actually is what euro dollar did on some day in the past that we're looking at here, and it's going to expire at 3 p.m. right? So as we start off, let's say this is 3 p.m. all the way here on the right side. This is 3 p.m. It's going to expire when it hits that point. As we start off here, we're right above where this strike price. So the market's right above the strike price. It's going to be pricing generally, pretty close to 50-50, right? If the market is fairly close, or just even a little bit above or a little bit below that strike price, we have a lot of time for the market to move. So generally, if it's right around that strike, the underlying market's right around that strike price, it's going to be, either right above 50-50 or right below 50-50. Again, this is 50-50 saying this would be like 54 on the sell side, 58 on the buy side if you wanted to get into that contract at this point. So as we see, as we move on, the market moves down a little bit, and now the same binary option might be pricing at 42.46, right? So now we're below the binary option, right? So if the contract were to expire here, we would actually need it to move up if we were on the buy side, right, to get our payout. So that's why it's going to be pricing a little bit lower than it was earlier, right? So the market's moving down. We need it to move back up, so it's going to be maybe priced at a little bit under that $50 sort of midpoint that you would expect if the market is sort of right on that strike price. As we keep moving, though, we see that we're getting closer to the end of the contract, right? So the contract's going to expire over here, and even though these 2 points on the chart are almost the same point, right? They're very, very similar in relation from the underlying market to the actual strike level. You'll see that the pricing is actually going down, right? Because we have less time for the market to move in our favor. So as we keep moving, the prices are going to start to sort of drift away from that middle line because you have less and less time for the market to sort of move in the direction you want it to move. But look, the market's moving in an upward direction here. And again, we see sort of the same thing here, right? So if we were, in the morning, right, when the contract opened up, it'll be a lot more like 50-50. But as we are getting a lot closer to the expiration of the contract, again, we see those prices starting to shift away from that sort of middle 50-50 line, right? And so in this example, maybe this is pricing at about $76 at this point. And again, we see we're actually even closer to the strike price here, but we're actually pricing even a little bit less. And then at the end of the contract, it's either going to be, I think this should actually say 0, 100, but on the buy side, this would be a $100 payout for the buy side if this actually was an expiration right here, and it would be a $0 payout for the sell side because the market is above this strike price. So that's a sort of real quick example on what can happen. And we're going to go through these next couple of examples a little bit faster because I think we did sort of just illustrate what is happening here with the price, with the time, and the underlying market's relation to that strike price. But just sort of to go over it in a little more detail, if in this example we just have sort of a strike price that is way above where the market's trading below that strike price for the entirety of the contract, and you'll see as we start off, we're still pretty close. We have a lot of time for the market to move in that direction, so we're just under that sort of $50 pricing. And as we keep moving, you're going to see that sort of drift away. Even though the underlying market is not really moving any further away from that strike price, you have less time for it to move in the direction you want it to move. And so as we go throughout the life of the contract, it's going to start moving that way. And then obviously at expiration, we have a $0 payout if we were buying on this side, and it'll be a $100 payout for the seller because it is below the strike price. And just another very quick example, but on the other side, right, we're going to start above the strike price. It's going to be right above 50, and as we go through the contract, it's going to, again, become more expensive because we have less time for the contract to move against us, right? If you're getting into a contract with, let's say, 5 minutes left, and it's been a contract that's been running for a day, and it's already above the strike price, you're going to have to pay a little bit more because there's a higher probability that it's going to stay above that strike price at that point, or less time for it to move against you. So that's what we have on the slides here. But now we get to jump into the actual what I find to be the most fun part of the webinar and actually getting to the platform and looking at it there. So let me pull this up. Yep. So this is going to be the login page for the platform. Let me take a little drink of my coffee here. So this is the login page of the platform. I will log in here. What is log into the demo? When you log into the demo, there we go. My awesome account, I like Nadex. We hit log in, and here we go. Here we have our platform. Now, if you're completely new to this, if you've never been into our platform before, I do a platform webinar on Thursdays. So I did one last Thursday. Definitely go check that out or sign up for the one in the future. But very basically, we're going to go and use this left-hand navigation to navigate and bring up a binary option. So we've been talking a lot about euro dollar. We can actually jump in and do a real euro dollar example here. So I get into Forex. We scroll down. We have our euro dollar contracts here, and we have our 2 hours that are going. So let's look at how these 2 hour contracts are pricing. We have all our pricing here, and actually looks like the market has really just shot down, kind of even while I've been talking about this. And so these actually aren't very good to look at for our examples. So let's choose something else. Let's see what the US 500 has been doing here the last couple hours. Okay, this looks a lot better for the examples we want to go through here. So over on this left-hand side, we have all of our strike prices that we've been talking about. So we have the US 500, and then on all of these contracts, you're going to have a certain number of strikes you have for any contract, right? And so you're always going to have either contracts that are fairly high above where the market is currently trading, fairly below the current market, and right on kind of an at the money contract that we call it, which is those contracts that are right around 50-50, right? If the underlying market, like right here, is trading right around the actual strike price. Let me also set this up so you guys can see this a little bit better. Okay, so in the middle of the screen here, you see I've clicked on my strike price. I brought up my chart in the middle of the screen. I also have my deal ticket on the right-hand side of the screen over here. I can choose my buy and sell here on either the chart, either the left-hand panel, or on the deal ticket itself. And so let's look at, so this is what we were talking about when we were talking about those contracts that are priced generally right around 50-50. So this contract is just a little bit above this strike level here. And so our pricing you see on the market is, about a little over 50 on the sell side and about 55 on the buy side. As we move up way above these, we have, contracts that are priced a little bit, as we move up, as we move away from where the underlying market's trading, we have contracts that are priced a little bit less because obviously you need a lot more movement for that to actually move in your direction. And if we go all the way down here, we have contracts that are priced in the 90s because again, the market is already fairly far above where this strike is trading. And so this is going to be priced a little bit higher. But for this example, let's look at, let's get into one of these that's right around 50-50 here. So we have this contract right around 50-50, and we have all of our different components, right? We have a US 500, that's going to be our underlying market that we're trading on. We have our 4407.4, that's going to be the strike price that we need the market to either be above or below at the expiration of the contract. And then 2 p.m., that's going to be 2 p.m. Eastern. Always important to remember that all of the contracts are quoted on Eastern time on the exchange. And then we have our buy and our sell price. So as we were talking about, these are always moving throughout the life of the contract. If I wanted to actually sell this contract, if I think this is going to, generally the market is going to move in a downward direction, or that the at expiration, it's going to be below this strike price, I can get into this sell contract. And we see here, again, important to remember what we're going to pay is going to be 100 minus the actual price we see here, while on the buy side, what we're going to pay is actually just the price that we are seeing here. So this $59, that's what we're going to pay. That's going to be our maximum loss on the trade. One other thing, if we go and look at the order deck, you can see all of the orders that are out there. So there are other people sort of pricing this always in the background, and this is demos. There's less people, but on the live exchange, there will be, you'll see more different prices out on the order book. And so, but basically what we are concerning ourselves mostly with, and especially on this webinar, is going to be the best available price on the buy and on the sell side. So I can do my limit order here. I'm going to do a market order just to sort of jump in. Actually, I'll go back to limit just to show one more time. So we have our, if this is $60 here, if we wanted to get in at $60, our max loss would be 60, and our maximum profit that we know right before we get into the contract would be 40, right? So if we actually hold this until the expiration of the contract, we're going to get 100 minus what we paid to get in for our maximum profit of 40, right? 100 minus 60, getting this profit of 40. Before we actually jump in and place this order, I do want to go over these couple numbers right here, this max ROI and this probability ITM. These are what we were talking about in the webinar a little bit earlier. That's going to be the probability of whatever event occurring, right? So probability ITM, that's going to stand for in the money. That's the probability of being in the money on this trade. So on the buy side, we're on the buy side right now. You'll see this probability ITM is pricing the middle of these two numbers, right? So just like what we were talking about, you can think of these because they're priced out of 100, sort of a whole 100%, whatever the midpoint pricing is, the percent chance that the market is pricing in that this event occurs. So we can know that, okay, the probability that this, the US 500 is going to finish higher than 4407, the market's pricing that at about a 54% chance that that happens. And then the maximum ROI, the max return on investment, that's going to be how much we're paying to get into the contract. So in this case, let's go with the market price. In this case, we would be paying about $56 to get into the contract for a potential return of about $44, giving us a max ROI of right around 75%, right? So that return on investment is just telling you how much you're going to get back based on your initial, what you're putting in. It's very important to look at these two because as we can see, if we go, let's look at a contract up here real quick. If you go look at a contract up here, right, which is pricing at about, $10, $11, we'll see, okay, well, our max ROI just went from, what were we before? We were about 70% max ROI. If we get into a $10 contract, hell, we can make 800% on our trade. Why doesn't everyone do this all the time, right? Why would I ever try to get into a contract that is pricing at a 70% ROI on my money when I can get into a contract that's giving me, now we're looking at almost 900% on it. So, this seems like a pretty good proposition, right? Well, you have to look at the probability of this happening, right? Because the reason that you're getting such a high potential return is that the probability of that return occurring is very low. So these two fields are going to be inversely related, right? As your maximum potential return is going to go up, the probability of getting that return is going to go down. And so if we actually, go down and look at one of these contracts that's pricing a lot higher here, we see, okay, I'm only getting about 13% return, right? If I paid $86 to get into a contract, I only have a potential to get about $14 profit, right? So that's only about, it's not a very high rate of return, only about 14–15%, but the probability of me getting that return is much, much higher than what we were just looking at a little bit earlier with that, potential return of hundreds and hundreds of percent. So to sort of answer the question of why would you get into a contract that has a lot less, potential return? Well, the answer is because the probability of you getting that return is a lot greater, right? So it's always important to look at these two numbers and just really understand what these binary options set. As you are paying more to get into a contract, your return is going to go down, but the probability that you get that return is going to go up. Okay, so we've talked about this quite a bit here. Let's go and actually jump into a contract itself. So I'm going to do a market order. A market order is just going to get me into the contract at whatever the best available price in the market is right now. And so let's hit that place order button. There we go. We see our position opening up right here at the bottom of our screen here. And we'll go over this very quickly. So we still have our probability in the money here. So this is still going to change throughout the lifetime of the contract, telling us the probability that this is going to occur, because obviously as the contract keeps moving, as the underlying market keeps moving up and down, the probability is still, even after we're in position, going to change throughout the life of the contract. We also see over here, we have our profit and loss. A very important thing about this profit and loss, excuse me, gotta blow my nose here. I apologize here. Got a little bit of allergies. Springtime, and my nose is always acting up. So we have here our profit and loss, and a very important thing about this profit and loss deal is that this profit and loss is only the profit or loss that you would take if you were to exit the contract right now. It is not necessarily the profit or loss that you would take if the contract were to expire right now. And so to sort of illustrate this, right? And actually, this is a fairly good illustration already. Let's get rid of all the other strikes we have here. So if we just look at the one strike that we're in, right? So this is the strike price that we need it to be, and we got it on the buy side. So we're basically saying I need this to be above this strike at the expiration of the contract to receive a payout. We can actually see, well, if I were to exit this contract right now, because I got into this contract at $66, if I were to exit it right now, I would need to exit on the other side of the contract. So I'd get whatever's pricing on the sell side. So I can sell this back into the market for about $51, $52, right? It's always going to be changing. So if I were to do this, I would take a loss of about $12, $13 right now. But if the contract were to expire, let's say instead of expiring at 2 p.m., this contract were set to expire at 12:45 p.m., right? So in 1 minute, if this contract were to expire in 1 minute, I would actually receive excuse me, I would receive a $100 payout. My profit on that would be 100 minus 66, so about $34. So we can see that if this were to expire right now, I would actually be profitable. But if I were to sell out of this contract right now, I would be taking a loss, right? Because all of this profit and loss, again, is showing you is what your profit and loss would be if you exit the contract right now. It is not the profit or loss necessarily that you will receive, or it is never the profit and loss that you will receive at, if the contract were to expire right now. And so the inverse could be true as well of what we just talked about, right? We were just sort of talking about an example where if this were to expire right now, it would be profitable. But if I were to exit right now, I would lose money. There are also examples. So for example, let's if I was in this contract, let's hope the market goes back up. I can place I can get into a strike basically up here at the top. And so let's say, just for example, that this was pricing. Let's say just that over the next hour or so, because we have about an hour and 14 minutes left in this contract. Let's say over the next hour or so that we actually get a rebound in the underlying market, right? That the US stock market starts to move in an upward direction. Well, generally, my contract, if it's moving in an upward direction, is going to be more valuable at that point, right? Because if I paid $8 to get in, we have the underlying market moving up towards this strike price. Well, my contract's going to be worth a little bit more because obviously it's a lot more, the chance is a lot more high. It's a lot more likely that this is going to be above my price here, right? So let's say it moved all the way up here. I paid $8 to get into this contract. Now maybe my contract is in this hypothetical. If the market was pricing around this point, it might be worth $40, right? In that sort of hypothetical, my profit and loss would be saying that I'm in a profit, right? I paid $8 to get in. I could exit right now at 40. But if it's sitting right here, that's still not above the strike price. So it could be showing a positive profit. But if it were to expire at that point, I would actually lose my initial investment because it is still underneath this strike price. So I know I've belabored that point just a little bit, but it is something that, especially people that are a little bit newer with binary options, it is something that I've gotten before with, it said I was profitable, but then it expired and I didn't get a payout. Well, it is just important to remember that that profit and loss you're seeing on the exchange is just the profit and loss that you would receive if you were to exit the contract right now. And we're not doing too well on these trades right now. You can see we're down about 25 bucks. That does tend to happen when I'm buying a contract. The market is moving the other direction on me. We can see if I was in a sell side contract, and we will get into a sell side contract here in just 1 second. Let's get into this contract here. So we have 22 on the buy side, 19 on the sell side. So let's say we think that this is going to continue moving in a downward direction, or it's going to be generally below this price at 2 p.m. We can get into the sell side contract here, and you'll notice here, I'll go back to the limit real quick. You'll notice if this is $20, what we're paying again is 100 minus what it's showing. So we're paying $80 to get into the contract. Our maximum profit is going to be $20. And we also have our ROI probability that we can look at here. But let's just jump in market. Let's jump in here. And there we go. I have my sell side contract in here as well. And as we can see, I am losing money on all three trades that I've placed because you know, I'm sort of just placing them as random, but we can chalk it up to also me being a bad trader. One other thing you will notice though is that as I enter these contracts, my profit and loss, I'll always start out a little bit negative. That's because basically if I enter into a contract on the buy side, I need to exit on the sell side. Or if I enter on the sell side, I need to exit on the buy side. And there's always going to be what we call the bid-ask spread between these two. And so to start making a profit, when you actually close your position, when you sell out of your position, you need to sort of make that spread first. You need the contract to move more than what that spread is. So if I got it at $20, the other side is 18. I need that sell side to move up over 20 before I even start making a profit on this, right? So we were talking a little bit about how we talked about what this profit and loss means, and we haven't really shown how you can actually exit this contract early. So let's go ahead and do that now. So we have this panel here where we're looking at all of our contracts that we actually currently have. If I wanted to just go ahead, close out of this contract, let's say the first one that I entered into, I'm already down 15 bucks. Maybe, you know, I realize that this is not a profitable position. I no longer want to be in this position. I can hit this close button, and it's going to bring up a different ticket on the right-hand side. That's going to allow me to go ahead and get out of the contract. Now, yes, I am taking a loss on this contract. However, this can be a very viable strategy to go ahead and actually exit the contract early, even at a loss, because I paid $66 to get in. Yes, I'm only getting $50 back. I am losing $60 on this trade, but I'm not losing the entirety of what I put in, right? I'm not losing the whole $66. I can sort of manage my risk a little bit. So if I go ahead, hit this close position, there we go, I've closed my position, and I am now out of the trade. Similar with the set profit target, we can hit this button here with our set profit target. We got in this contract at around $9. Let's say if the market moves up a little bit, let's say the market moves up to, I don't know, the contract's pricing at $29, right? We can put in that we would like to exit the contract if the market gets up to $29. I can place my limit order, and basically what this will do is it won't get me out immediately of the contract. It will just get me out whenever it goes, whatever the market starts pricing at that $29 point. So if I place this limit order, we can see I'm still in my position. It didn't disappear out of my open positions panel. It's over my order panel. And basically this is just saying, if this market gets up to $29, right, at a point where I would be making $20 on the trade, get me out at that point. So that's going to be how you actually set your set profit target, how you actually close your position. Let's go through here. So I believe actually that's most of really what we want to cover in actually going into the platform, actually placing these trades in the platform, getting that set profit target, and hitting that actually closing out of that position. If you do have any questions, you can throw them in the chat here. Let me go back and yeah, so that's going to be basically all we really need to go over on this webinar here. So yeah, if you do have any questions, go ahead, throw them in the chat. But that's going to be the very basics of actually how you get in, how you actually trade these binary options on the Nadex platform. So I will give a few minutes here at the end of the webinar for any time to go in, throw in any questions, ask anything that maybe I didn't cover that you were a little unclear about. I know I did go through these a little bit quick here, and that we started a little bit late because of some technical difficulties. So if I did brush over anything, we can go over it. We can go over it here now. I do have a question coming in here. How did you remove all the other lines to only see your contract? Great question. This is one of my favorite things that sort of a little bit hidden things to do on the platform. So There's a couple ways you can actually do this, and I do go over this in my sort of the chart webinar I do. So you can either just hit the S key on your keyboard, and that's going to toggle all of your positions, right? So you have, when you actually hit the S, it's going to either hide all of your other strike prices that you actually have on the chart itself, and hitting S again is going to go ahead and bring them back. The other way that you can do that is you can right click on the chart and go down to show and select strikes, right? So if you, this button right here will also toggle this, but it's also has a hotkey that is S. So that's generally how I do it, is I just hit the S key, and that's going to toggle it'll basically toggle all the positions on or off, and it'll just show you the one position that you have. So it's a good question. It is actually probably one of the things I use most on the platform when I'm trading. If I want to bring all the other positions up, see how everything else is pricing, and then sort of put them away and just focus on the one that I have. One other thing that I'm realizing I didn't go over, so thank you for sort of reminding this, is you do also have your representation of the price and of your profit and loss on the chart itself. So you can see we have my two positions that are still trading here, and they're both referenced on the chart itself. So I have my -1 that's going to be representing that this is a sell side contract that I have, -1, and then above 4411.4, that's my strike price, obviously, and then we have my my loss that I'm making currently on this contract. If this does actually go into a profit, these lines will be green rather than red, these little boxes. We also do have, so these are the open positions that are either going to be red or green that are going to be on the further left. And then we do have our, excuse me, we have the order showing as well. So this little grayed out box, that's my working order that we put in earlier to actually go ahead and exit the contract early. But yeah, great question, because it is something that I use very often, is toggling the strikes on and off. So using that S key is something that I do all the time. Are there any other questions that we do have in the chat here? I'll give it a couple more minutes. While I actually do wait for a few more questions, I will put this slide up here. Oh. Let's get all the way back through our slide deck here. Oh, I should have just started the webinar from this screen. So while I do wait for any of the questions to come in, these are going to be the different ways you can actually go ahead and contact us. So if you do have any questions, if you're watching this on the recording a little bit later, or you are just have a question that you realize you forgot to ask while we were on the webinar itself, you can go to customer service at nadex.com. You can send in an email to that. That's probably going to be the best way to get a fairly quick response to any questions that you have. You can also go to our site, and there's going to be a little live chat box on our site. You can use live chat as well if you have a question that's maybe a little bit less in depth and you just need a faster answer to. But generally, the best way is going to be emailing us at customer service at nadex.com. Excuse me. We also have all of our socials here. So we have Twitter, Facebook, Instagram, YouTube, LinkedIn, all the goodies, all the biggies. And we're basically Nadex or Nadex US, Nadex Official on all of these. The YouTube channel is where this recording of this webinar will be. So if you missed any of the webinar, if you missed me fumbling around at the beginning of this webinar and trying to get everything to work with the sound, go over to our YouTube channel and watch me fumble around with the sound again. But not only is this webinar going to be up after the conclusion, but the recording of all the other webinars I do. So every Thursday I do a webinar at the same time. As well as just our recordings and different learning videos that a lot of people do on Nadex, a little more short form content as well. I'm just getting all tongue-tied here today. And then lastly, if you are liking what we are doing here, if you're liking trading at Nadex, you can leave us a review at trustpilot.com. It does help us out. Our marketing team always likes me to go ahead and plug that at the end of these webinars, but it does really help us. So if you are enjoying trading here, go to Trustpilot, leave us a review, and let us know what you think of everything. I'm not really seeing any more questions come in. I will give it one more second here because we still have a couple minutes before noon. I don't see any questions in the next couple minutes. We're going to go ahead and call it. Yeah, I think we'll go ahead and call it at this point. Again, I do apologize for any of the technical difficulties at the beginning of this webinar, and how we had to go through a little bit quicker because of that. But I hope that this webinar was informative on how to get through the basics of trading binary options here on Nadex. Thank you for coming and hanging out, listening to me talk for about an hour now. This will be drone on. If you do like hearing me explain our different contracts, our different platforms, our charts. I do a webinar, like I said, at this time every single Thursday. So check back. I believe next week is going to be on call spreads and knockouts. So if you want to come in, learn a little bit about call spread and knockouts, that'll be next week. And then also you can go check out all the old ones on the platform with charting, everything as well. So I'm going to call it there. Thanks so much for hanging out. Everyone stay safe out there. I know the world's always crazy. But stay safe up there. Good luck in all of your trading, and have a great day, everyone.